Welcome back to the Explainer. Let's jump right into it because today's data is absolutely fascinating. We're unpacking a highly detailed daily macro strategy report dated August 27th, 2026. If you've been watching the markets, you know things feel a little precarious right now. And the overarching theme of today's report hits the nail on the head. We are witnessing a massive structural transition in monetary policy. We're talking about a shift away from reactive measures and toward predictive analytics, all while trying to navigate some really intense geopolitical stress. It's a lot to process, so let's dive in.
Here's our blueprint for today. We'll be walking through macro sentiment and foundation, treasury and currency dynamics, equity market microstructure, sector rotation, and wrapping it all up with strategic action and the final verdict.
Starting off with Section 1, Macro Sentiment and Foundation.
So institutional analysts right now are aggressively shifting away from those broad, sweeping market narratives, and they're zooming in on hyper-specific data points. Look at this quote from Fed Chair Kevin Warsh over at the Jackson Hole Symposium. He explicitly said, "Current data is more important than trying to predict future data." The report highlights this as a noticeably hawkish pivot. The Fed is moving toward a predictive analytics model, rigorously focusing on real-time demand rather than just coasting on the lingering effects of past rate hikes. Throw in Fed official Jeff Schmid's recent comment that conditions might still be a little accommodative, and you can clearly see the central bank is not ready to declare victory just yet. To really understand this, the report deconstructs the structural upward pressures on inflation by tracking some very specific Fed data series. It's like a giant puzzle. Take shelter, for instance. It's sitting at an index value of 429.10. Analysts are looking at this in the context of localized housing supply pressures, actually drawing direct parallels to the debates we're seeing over UK migrant dynamics. Then you've got used cars and trucks at 180.31, which is being driven up by replacement costs tied to supply chain protectionism. And finally, look at service inflation, hovering way up at 445.62. This is being mapped directly against the ongoing political debates regarding foreign labor replacement. It's wild to see how analysts are literally quantifying these highly charged geopolitical debates and turning them into hard inflation models. Now here is where things get really tricky. How does this sticky inflation data cross-validate against what's happening in the labor market? Core CPI is holding firm at 336.79, and core PCE is at 130.66. But at the exact same time, we're seeing the BLS labor data cool off. We are actually looking at negative trailing 3-month job growth. The report systematically tears down the traditional market assumption that soft employment automatically guarantees immediate, aggressive rate cuts from the Fed. Honestly, the inflation metrics are just too sticky for that simple bad news is good news correlation to work right now. Okay, moving on to Section 2, Treasury and Currency Dynamics. We have to look at the fixed income foundation because this literally dictates the cost of capital across the globe. We need to understand how systemic liquidity drains are acting as massive constraints on future growth. Look at today's yield curve configuration. The 10-year Treasury is at 4.64%, and the 2-year is at 4.17%. That leaves the 10-year to 2-year spread at 0.47 percentage points. But wait, the report also flags the 10-year to 3-month spread, which is sitting at a really steep 0.81 percentage points. The main takeaway here, these elevated real rates are actively threatening banking profitability. Remember, banks borrow at high short-term rates to lend long-term. This kind of setup signals what analysts are calling an entrenched economic plateau. And speaking of constraints, let's check the plumbing of the global financial system. On the left side here, we have the dollar index, the DXY, holding incredibly strong at 118.06. The report refers to this as the straw effect. Basically, this dominant, ultra-strong dollar acts like a giant vacuum, sucking capital right out of emerging markets. Now look at the systemic liquidity on the right. The Treasury General Account balances are massive right now, over $953 billion. Meanwhile, the reverse repo facility has compressed down to practically nothing, just $0.46 billion. This shift is fundamentally altering institutional liquidity. It's pulling cash out of the immediate banking system, locking it up in the Treasury, and effectively draining fuel from the broader markets.
Let's look under the hood in Section 3, Equity Market Microstructure.
When you look beneath the headline index levels, things get a little dark. The report uses historical parallel models to show exactly what happens when high-yield credit spreads widen out rapidly over a rolling 3-month period. Spoiler alert, small-cap equities get absolutely hammered. Look at the Russell 2000. It's facing an average 12.4% drawdown. Why is it being disproportionately penalized? Well, these smaller companies are constrained by high leverage and aggressive refinancing walls. Compare that to the S&P 500, which is dealing with margin compression, or the Nasdaq, which is fighting initial liquidity drains before growth buyers step back in. It's a completely different risk profile.
With that structural weakness in mind, the report explicitly zeroes in on the Russell 2000's current pricing. It's sitting at 3,016.48, which is up a very modest 0.35% for the day. Institutional allocators watch this exact index like a hawk. It's their definitive barometer for risk appetite. The big question analysts are asking right now is this modest daily gain a sign of healthy market breadth expansion, or is it just a fragile, temporary short covering bounce? To figure that out, we have to look at the divergence in risk signals. The spot VIX volatility index is surprisingly chill, compressed at just 15.21. You'd think everything is fine, right? Well, underneath that calm surface, the high-yield spread is at 2.67%, and real-world credit defaults, especially credit card defaults for lower quartile consumers, are actively accelerating. The report highlights this as a highly dangerous divergence. There is a massive disconnect between how the market currently perceives equity safety and the actual on-the-ground credit stress we're seeing.
All right, Section 4, Sector Rotation and Alpha. This is the tactical core of the report right here, tracking the actual institutional capital flows. We are looking at a highly fractured market with a really stark divergence. Out of all 11 GICS sectors, technology, the XLK, is up a massive 3.14%. Meanwhile, literally every other sector on the board is bleeding red. The report emphasizes that institutions are aggressively chasing this AI rally, blindly concentrating their capital into tech, while simultaneously dumping rate-sensitive and value sectors. It's a massive polarization in the market. But what's driving this? Here is how analysts are translating geopolitical noise directly into structural alpha. On the left, we have the devastating glacier collapse and flooding in Nepal. It's an ecological tragedy, absolutely, but the report links it directly to the XLU defensive thesis, exposing the sudden, acute fragility of our global hydropower grids. Then, on the right, look at the heated domestic political warnings regarding socialism and affordability. Analysts map this directly to consumer staples, the XLP ETF. The thesis is that this intense cost of living scrutiny is acting as a permanent cap on corporate pricing power and profit margins. It's fascinating how macro events directly hit the sector level. Over in the commodities market, we're getting two very distinct, almost conflicting signals. WTI crude is falling. It's sitting at $83.90 a barrel, down $2.44 on the day. This heavily implies a level of recessionary demand destruction, basically people bracing for an economic slowdown. But on the flip side, gold futures are soaring, up 1.39% to $4,662.30. Investors are actively treating gold as a safe haven, trying to find protection against both sticky inflation and the broader market uncertainties we've just been discussing. And we definitely can't ignore the digital asset space in a macro report of this caliber. Bitcoin is trading at $80,014.99, up 1.25% for the day. The report explicitly defines Bitcoin's current structural role in these institutional portfolios as a systemic hedge against instability. Much like gold, it is catching bids as a digital safe haven right now, while the traditional credit markets are starting to show these underlying signs of stress. Finally, let's bring it all together in Section 5, Strategic Action and Verdict. So how do portfolio managers actually synthesize all this raw data into portfolio adjustments? The report lays out some very exact parameters. In Scenario A, the bullish case, we need the Magnificent 7 tech stocks to successfully break out and drag the broader indexes up with them. If that happens, the move is to overweight technology, or XLK. But in Scenario B, the bearish case, that consumer credit default cascade we saw earlier, forces a broad rotation. If that hits, managers are instructed to overweight gold and underweight consumer discretionary. But don't ignore the tail risk. The report sternly warns of a black swan scenario where cascading hydropower grid failures merge with Middle East supply shocks. That would severely cripple both the utilities and energy sectors in a heartbeat. Which brings us to the final verdict for today: cautiously bearish. The report explicitly instructs allocators to prioritize a defensive posture right now. Late cycle markets are famously unforgiving, and quite frankly, everyone is holding their breath for tomorrow's most critical data point, the core PCE deflator. Will the data confirm the Fed's new predictive models, or is it going to trigger that dreaded credit cascade? That is the billion-dollar question we'll be watching closely. Thank you so much for joining me on this deep dive into the institutional mindset. Keep your eyes on the data, and I'll catch you in the next explainer.